Welcome to this video from Kepsfield Academy. In this video, we'll provide a comprehensive yet simplified introduction to reorganizing accounting statements to determine free cash flow. You will learn the importance of reorganizing accounting statements for DCF purposes, basic concepts of the investment balance sheet, net operating profit after tax, NOPAT, and calculating free cash flow based on NOPAT and investments in capital employed. Accounting statements serve a crucial function in providing historical records of a company's financial performance and position. However, for valuation purposes, such as DCF analysis, accounting statements need to be reorganized and adjusted. An investment balance sheet is a reorganized financial statement that segregates operating and non-operating assets and liabilities. Note that the investment balance sheet has assets and liabilities that sum up to capital employed, and financing as opposed to the accounting balance sheet that splits assets and liabilities to each side of the balance sheet. Also note that liabilities in capital employed are negative numbers, whereas liabilities represent positive numbers under financing. Capital employed and financing always add up to the same amount. Capital employed is defined as the sum of the operating assets and liabilities. Capital employed is relevant for valuation and value creation because it represents the resources invested in the company's core operations that generate free cash flows. Analyzing capital employed helps determine the efficiency of a company's use of its resources in generating profits and creating value for its stakeholders. Capital employed consists of fixed assets such as property, plant, and equipment, and net working capital, which is the difference between a company's current operating assets and the current operating liabilities. The financing part of the investment balance sheet includes all assets and liabilities not directly involved in the company's core operations. This part of the investment balance represents how the company's capital is financed. In the context of a DCF valuation, the modified income statement serves to adjust a company's reported financials to derive the relevant cash flow metrics needed for the analysis. The starting point for the adjusted income statement is NOPAT. NOPAT, or net operating profit after taxes, gives us insight into a company's operating profit after considering taxes. It's essential for understanding the potential cash flow generated by a company's core operations before any investments in fixed assets or net working capital. To calculate NOPAT from an income statement, follow these 3 simple steps. First, locate the company's operating income, also known as EBIT, earnings before interest and taxes. This value represents the profit generated from the company's core operations, without considering financing costs. Next, determine the tax expense on the adjusted operating income by multiplying it by the company's effective tax rate. The effective tax rate is the average rate at which a company's pre-tax profits are taxed. To calculate it, divide the total tax expense by the company's pre-tax income. You can find this data in the financial statements, typically within the income statement or the notes accompanying it. Keep in mind that this tax expense differs from the one reported in the financial statements, as it only considers taxes on operating income. Finally, subtract the tax expense from the adjusted operating income to obtain NOPAT. Now that we have reorganized the financial statements and calculated NOPAT, we can calculate free cash flow. FCF represents the cash generated by a company that is available to all capital providers, both equity and debt, after accounting for investments in working capital and fixed assets. To calculate free cash flow, we start with NOPAT, add back depreciation and amortization as these are non-cash expenses, adjusted for changes in net working capital, and finally subtract capital expenditures. The first 2 steps in the free cash flow calculation are relatively straightforward. We have discussed the calculation of NOPAT. Depreciation and amortization can be found directly from the income statement. The adjustment for net working capital requires a little more explanation. The change in net working capital affects the company's cash flow. An increase in net working capital is an investment and thus reduces free cash flow, whereas a decrease in net working capital reduces capital employed and thus increases free cash flow. The net working capital change can be calculated by subtracting the current net working capital minus the net working capital balance from the previous period. From the investment balance sheet we prepared earlier, we find that net working capital decreases from 10 billion euros to 3 billion euros. This leads to a positive adjustment in our free cash flow calculation of 7 billion euros. The next step is the calculation of capital expenditure, or CapEx. Capital expenditures are investments made by a company to acquire or maintain long-term operating assets, such as property, plant, and equipment. PP&E. CapEx is not directly reported on the balance sheet or income statement, but you can calculate it using information available in these financial statements and related notes. Capital expenditure is equal to the change in PP&E plus the depreciation expense. The change in PP&E is calculated as ending balance of PP&E minus beginning balance of PP&E. From the investment balance sheet, we find that the net balance of fixed assets increases by 1 billion euros. The depreciation is 3 billion euros. Therefore, capital expenditures in 2022 were 1 billion euros plus 3 billion euros in depreciation makes 4 billion euros. This is a cash outflow. We have now calculated all components of the free cash flow. Free cash flow equals NOPAT of 7,930 million euros plus depreciation and amortization of 3 billion euros plus 7 billion euros from the decrease in net working capital minus 4 billion euros in net capital expenditures makes 13,930 million euros in free cash flow. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.